we do have a couple of other topics that are related to the key steps. And Brian, do you want to start the conversation on that?
Sure, Rich, thanks. So we're going to start off with licenses. So the guidance on licenses today is there's a lot of different guidance, actually. So you have guidance, say, for software licenses, different guidance for franchising arrangements, guidance for things like films and broadcasting. So there's a lot of different guidance on licenses. So now there's just going to be one model under the new standard for licenses. And when we're talking about a license, so you're talking about a situation where you give a customer the right to use some form of intellectual property. Could be software, could be a movie, could be a brand name, could be trade name, could be lots of different things. So you're not giving ownership of that intellectual property to the customer. You're just allowing them to use that. And so the first thing that has to be evaluated, because there is very specific guidance for licenses in the new standard, you have to evaluate, well, what is my performance obligation here? Or what am I delivering? Am I delivering just a license of intellectual property? In which case, as we talk about the model on the next slide, it'll be straightforward as to what you're applying it to. Or are there multiple items? So if there are multiple goods and services, I have to perform step 2 initially and determine, should I account for that license separately from the other performance obligations? If I do, then I move on with that license and apply the license-specific guidance. If I don't, and I have to account for that license and the other goods and services on as a combined performance obligation, then you would still look to the guidance we're going to discuss on timing of recognition and how to evaluate that, but that doesn't necessarily mean that you would, for example, recognize a license, say up front, if there were some other goods and services, even though the license guidance says that, because you have to apply the guidance. You have to look at it holistically in the fact that it's not just a license. There are multiple items within that performance obligation. So it's very important to make sure before you go ahead and apply the license guidance, you know what your performance obligations are and whether it's just a license or if it's a performance obligation that includes a license and other goods and services. So let's assume you have a situation where you have just a license or you're accounting for that. You have multiple items, but you're accounting for that license as its own performance obligation. So the key item to evaluate here is, what do I recognize that license at a point in time? So when I transfer the right to use that license, or do I recognize that license over time? So as the customer has the right to access that license. And so what the guidance says is, well, that depends. So it depends on whether the ultimate underlying intellectual property has significant standalone functionality or not. So can that intellectual property be used on its own and provide some sort of benefit to a customer? So typical items that will, intellectual property that will have significant standalone functionality include things like software. That software can generally be used on its own. Or things like, a license to some sort of say a pharmaceutical product, a drug compound. So that license to use that particular underlying formula, that's going to have functionality on its own. Or the license, the right to broadcast a movie or a TV show. Well, that can be used by itself. It's functional on its own without any other items. So if you have a situation where that intellectual property has significant standalone functionality, what you would do is you'd say, okay, that is IP that is functional IP. So I'm going to, that's considered, I have a right to use it. So I have a right to use it as it exists when it's transferred to me as a customer. Therefore, the entity has transferred control of that right at a point in time. And so you'd be able to, in that case, recognize revenue for that license at that point in time when the customer has the right to use it. And that's regardless, it doesn't matter whether it's a perpetual right or, it has a specific term. So the fact that it has a term doesn't mean you automatically have to recognize it over time. You're recognizing it, you're recognizing revenue if it has significant standalone functionality at a point in time, regardless of whether it's a term or a perpetual license. Now, if it doesn't have significant standalone functionality, it will be considered symbolic intellectual property. So think about a license to use a trade name or a brand name of some sort. That is the benefit of that name, in my example, is that it is associated with the ultimate, operations of the entity licensing it out. So you license out a brand name to a baseball team, so you can put it on some shirts. Well, that's going to be affected, the value of that license is going to be affected by how that team is performing generally. So those types of situations, that's considered a right to access that license, and it's considered a right to access it as it exists throughout the contract period. So therefore, since it's symbolic intellectual property and it's not a right to use, it's a right to access it as it changes over time, that will be considered satisfied over time. So you'd recognize the revenue for those types of licenses generally over the arrangement period. Okay, another area we wanted to discuss is principal versus agent. And I kind of brought this up a little bit earlier when I was talking about the gross first net guidance on sales taxes. So there are some similarities to today's guidance, but I think conceptually it's a little bit of a different approach. So here what we're looking at is situations where you're performing for a customer, but you're involving third parties, whether it's involving a third party that provides the goods, so you're buying some goods from a manufacturer and then selling it to your customer, or the third party might be providing some part of the services. So you might be providing some sort of construction services, but outsourcing a part of the contract to a third party. So the question there is, well, in those situations, am I a principal in the arrangement, in which case I would recognize revenue for the amounts received from the customer, and then cost of goods sold for the amount paid to that third party that I'm working with? Or am I an agent, which would mean you recognize revenue on a net basis, and I would just recognize revenue for the difference between what I paid, what the customer paid me, and what I had to then pay out to a third party. So two key steps in this evaluation. First, you have to figure out what are the specified goods or services I'm providing to the customer. That's what you're going to evaluate to determine whether you're a principal or an agent. And this one can get a little confusing when you're evaluating the specified goods, but the key part here to evaluate is, well, are you providing the goods themselves, or are you just providing a right to those items? So the example we have here is we have a ticket aggregator. So a company is going out buying a whole bunch of plane tickets and then ultimately selling them to customers. So in that situation, this ticket aggregator is not flying the plane. They're not in control of flying the plane, but they're providing a right for a customer to get on that plane and get that transportation. So in that case, the specified good or service that's going to be evaluated to determine whether you're a principal or an agent is the right to fly on that plane, not the flight itself. And what you have to do is, with that specified good or service, the evaluation is, well, do I as an entity, am I obtaining control of that specified good or service before I give it to the customer? And there could be cases where, and we'll talk about how you evaluate that control, there may be cases where you're providing multiple goods and services, in which case, again, you need to apply step 2 first, to first determine your performance obligation based on that specified good or service. And then there's also there's some guidance that some indicators that you're also going to evaluate when you're determining whether you control that good or service before it's transferred to the customer, which we'll talk about. So the general notion of control that Rich talked about in step 5 applies here, in that you're evaluating whether you obtain control before you transfer it to the customer. So you're looking at the same control principle, but it's just a different spin on it, in that you're looking at, do you obtain control before transferring it to your customer? And because it wasn't very clear from the initial guidance, they had an additional ASU that addressed this issue and added some situations where they said, well, here are cases where you would be obtaining control before you transfer it to your customer. So the first one's relatively straightforward. Did you obtain control and then transfer it to your customer of some good or an asset? So think about a retailer buying a product from a manufacturer. Generally, they would be considered to obtain control of that product in most cases, and then it's then transferred to a customer once the customer buys it. So that would be a clear case in many cases where you obtain control before transferring it to your customer. So you recognize revenue as a principal. You recognize it on a gross basis. not as clear when we're talking about services. So they included a couple situations where you would obtain control to a service before transferring it to a customer. The first would be, do you obtain control of a right to a service that you can then transfer to your customer? So think about a situation where you're an entity, let's say you are providing some sort of service to your customer, but you're going to be using third parties. And you go ahead and say, well, you know what, I need to make sure I have that third-party service available. So even before I get a contract with a customer, I'm going to contract with this third party and say, third-party entity, I want to contract for 1,000 hours of service from you. I don't know who my customers are, but I'm going to pay you for 1,000 hours of service, and if they're not completed within a year, I'm going to pay you that money anyway. So in that case, you obtain the right to control that service and direct that third party to your ultimate customer before you have that customer identified. In that case, you'd say, yes, I meet this control guidance to transfer control to a customer obtain control prior to transferring it to a customer, so I'm a principal. The last item would be would say, well, are there situations if you obtain control of that good or service and then you take it and combine it with other goods or services before transferring it to the customer? So take a situation, we'll go back to construction contract accounting, where you use a subcontractor. That subcontractor is just performing part of your overall performance obligation to, say, build a house. Where you're combining their work with your own work and then ultimately transferring the house to the customer. Therefore, you would have meet the criteria and you'd be a principal in that situation. Now, if it's not clear whether you meet those control criteria to obtain control before transferring it to your customer, then there's also some other indicators. And these are the indicators these indicators are in current GAAP to evaluate gross versus net. But in current GAAP, it's just these indicators themselves. These indicators, plus there's actually a few more that aren't included in the new guidance, but do exist today. But they're not based on whether you obtain control. They're just indicators that are to be evaluated. Whereas under the new guidance, it's all in the it's all contributing to your evaluation of whether you obtain control before transferring to the customer. So you see the indicators here: primary responsibility for fulfillment. So is the customer looking to you as the vendor here? Are they looking to the third party? Do you have some inventory risk? Can you set the prices at a price you want? These are all indicators that you obtain control before transferring it to a customer. And I think in many cases it will be, just like today, in many cases it will be judgmental to evaluate whether you're a principal or an agent. That's no different from today. There are a lot of situations where it is unclear whether you're a principal or an agent. So it'll be the same thing under the new guidance, except a little different spin on how you're evaluating it. So ultimately, if you conclude when you're looking at the specified good or service that you are a principal, you include that amount in your transaction price, recognize revenue on a gross basis. So you recognize revenue for all the amounts you receive from your customer, cost of goods sold for the amounts paid to the third party. If you conclude you're an agent on the specified good or service, then you're really not providing that good or service. Right? You're not ultimately providing it. What you are, you're a conduit in that transaction. You're an agent in that transaction. So what you're getting paid and what you should recognize as revenue is the net amount retained. So if you were, say, you were a travel agent and you a customer buys a ticket from you for $100 or $300 and you pay the airline $270, what you're providing is that service of getting that particular flight. Your amount you're getting paid is that difference between the $300 and the $270. You're getting paid $30. So that's the amount you record as revenue, because that would be on a net basis. Okay, I have a few other topics here. I'm not going to go through them in detail, but I'll touch on them. So bill and hold transactions would be situations where you don't transfer the goods to a customer right away, but you hold on to them, but you bill for them in advance. So the question here is, when can you recognize revenue even though you don't ship the goods? And this guidance is somewhat similar to today. There are a few less, not necessarily as many criteria as there are today. Particularly, there's no criteria to have a fixed schedule for delivery. Customer acceptance is pretty consistent with today's guidance. Unexercised rights or breakage. So these are situations where you sell something to a customer, but they're not necessarily going to use all of it. So think of a gift card scenario. You sell a $100 gift card to a customer, but based on your history, you know that on average customers are only going to use $90 of that. And so the question is, what do you do with that $10 difference? And this guidance talks about, well, you recognize that as you perform on the other $90. And in some cases, it will be similar to today, but today there's actually a few options as to how to treat breakage. Uninstalled materials. So uninstalled materials, these are situations where you have a contract with a customer, you're transferring some goods and services, and the goods, you might transfer some goods early in the process and not use them for anything yet. So you might have a big construction project and you might be transferring, a whole bunch of lumber or other types of materials to the customer, and you technically transfer control of them, but you're not doing any work on them yet. So in these cases, what you would do, the guidance says, well, if you transfer control, you have to recognize revenue related to those goods. However, if you're actually not doing anything with them today, the question was, well, should you recognize revenue, at the full margin of the entire contract? And what this guidance, what ASC 606 says is, in these situations, you may have to recognize revenue just equal to cost. So you recognize whatever your cost is, that's your revenue at that point in time, which is different from today's kind of contract accounting guidance, because today what you would do in these situations is you generally exclude the cost from your measure of, if you had a cost-to-cost measure of revenue recognition, you generally exclude the cost. So that's certainly a change. Consignment arrangements, relatively consistent with today. Last item on repurchase agreements, this will be a change. So repurchase agreements are situations where, let's say, you have a call or a forward. So you have either an obligation to repurchase the item or the right to repurchase the item. Under the new guidance, if you have those sorts of rights or options as a vendor, then the customer can't control that good. So you wouldn't be able to recognize revenue in those cases. And depending on particular facts and circumstances, you might be different treatment. If you have a put right, if the customer has a put right so they can put that good back to you, well, then you may have transferred control to the customer. It depends on a couple different facts and circumstances again, but there are different potential results. It could be a sale with a right of return, or maybe a lease, or it could be potentially a financing. So a few different scenarios today, and that may be different from the treatment under today's GAAP.